Welcome to Trader TV, your insight into institutional trading. I'm Dan Barnes. 2022 has been a challenging year across both credit and emerging markets. However, electronic trading has helped people to navigate a better path to find liquidity. To discuss why and how this has been, we're going to speak with Tanya Munro and Ted Husworth of TradeWeb. Welcome back to the show.
Thanks for having us, Dan.
Great to see you, Dan.
What's driving the growth of electronic trading in the credit markets today?
Proving best X, achieving best X, and all of the data that goes along with that continues to be an extremely important factor that's pushing electronification. Alongside that, the trading platforms have continued to expand in a couple of different directions. One, the existing protocols, like the tried and true RFQ, there's been expansion in usage of RFQ because of new features that platforms have innovated, such as auto trading and multi-client net spotting at TradeWeb. And then along on a different axis, we have more and more protocols platforms are offering their clients tailored to how clients want to trade. A perfect example of that is portfolio trading. So more protocols, more functionality, also leading to more data, tying back to clients having a lot more touch points when they trade electronically than if they're trading over the phone.
So why is portfolio trading so attractive in corporate bond markets, and how do you see that evolving?
We've seen a very significant adoption from our client base in trading portfolio trades electronically. With more clients, we have more types of clients, we have more use cases. And the one thread through all of those use cases is this certainty of execution. I want to trade a basket. I want to get it all done at the same time. So whether I'm looking to seed a new portfolio, whether I'm looking to rebalance my portfolio, whether I have a long-short strategy I'm trying to accomplish, getting that all done in one go is extremely important. It's really the theme of more. So we're talking about more line items. People want to trade north of 2,000 line items now, more asset classes within a portfolio trade where it might have just been IG and high yields 2 or 3 years ago. Now we're seeing it expand into Europe and into EM and then across regions. So it's really that theme of putting more into portfolio trading, getting more liquidity within a single basket.
Tanya, why are clients turning to portfolio trading in emerging markets?
Similar to the IG space and the high yield space, in emerging markets, people really care about certainty of execution. We have a liquidity issue across the markets, but in EM, it's especially challenging, where we're basically covering 85 countries in a very unique geopolitical and macroeconomic environment. You've got a war, you have, the after effects of a global pandemic, you have inflationary pressures as well as recessionary fears. All of this makes it very difficult to know where to go to source liquidity for such a broad asset class. It can be very challenging if you're trading line item by line item. So liquidity, I would say, is a huge draw to portfolio trading. It also can be very attractive from a cost savings perspective. If I can take a basket of risk and package it together, dealers on the other end of that find it sometimes much more attractive than trading something line item by line item. And lastly, I would say the time savings, right? There's a real opportunity cost to taking, a week perhaps to trade 1,000 line items versus doing it all in one go. Investors are finding that in the EM space very, very attractive.
So what are some of the challenges that dealers might face when they're adopting portfolio trading in the EM space?
Dealers really have to have truly global desks. It's not enough to say, okay, I cover EM and I'm going to cover it from New York. The time zones make it challenging. Dealers are also realizing that they really do have to be portfolio specialists. It's not, in many cases, enough to trade portfolios off of an ETF desk. The most successful dealers in this space are really creating a separate business out of portfolio trading.
What role does portfolio trading have in the acceleration of electronic trading more broadly?
So I'd say portfolio trading has brought a lot of innovation to the credit markets. And some of that innovation has been on the dealer side. To trade a portfolio trade means you have to have the ability to price thousands of CUSIPs, multiple thousands of CUSIPs. And so that's continuing to evolve. And the dealers are continuing to invest in the technology and the connectivity to the other markets that they're sourcing liquidity. And that mainly with portfolio trading, that's the ETF market. So as this market continues to electronify, we're going to continue to see both the buy side and the sell side invest in the data and the analytics that go with how do I optimize my execution and what makes a good portfolio trade, and then how do I interact with the ETF ecosystem pre and post or as a substitution. So I think we're still very early in that transition to really connecting those two markets.
That's excellent, Ted. Thank you. Tanya?
Look, I think that portfolio trading helped dispel the myth that electronic trading doesn't necessarily work for very illiquid names, right? That's a very common theme in the emerging markets. And if I'm an investor and I have to trade Kazakhstan today, in the past, there might have been this thinking that that's too illiquid of a name to do on screen, right? And the fact that you can take a basket of bonds with varying liquidity and different risk profiles and get executed, I think has made a believer out of a lot of skeptics regarding electronics trading.
Guys, that's been great. Thank you both so much.
Thank you, Dan.
Yeah, thanks for having us, Dan.
I'd like to thank Tanya and Ted for their insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net.